In this video, we will be discussing about the third element of financial statements, which is the equity. If you can recall, we discussed assets and liabilities in the last two videos, and now we will discuss about how the standards have defined equity and what makes it so different from the first two elements that we covered. But before we go through all of that, again, I would like to welcome you all to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now, let's go back to the video. I have always found it interesting that across the standards and in the conceptual framework, equity is not specifically defined, unlike assets and liabilities, but rather, it is just defined as the residual interest in the assets of the entity after deducting all of its liabilities. This is the exact definition that you will see in Chapter 4 of the Conceptual Framework. So, according to the Conceptual Framework, still in Chapter 4, equity is one of the five main elements of the financial statements next to liabilities. So we have assets and liabilities, which we have discussed in the previous videos, equity, income, and expenses. Using this illustration, the conceptual framework is saying that equity is the residual claim after giving your resources or your assets to pay all of your liabilities. So it is really kind of a residual definition. Also, when you scan through the standards, the next mention of equity will be in IAS 32, Financial Instruments Presentation, where an equity instrument is defined as any contract that evidences a residual interest in an entity. So that is in IAS 32. So as you can see, unlike assets and liabilities, it has not been defined even in IAS 1. However, in IAS 1, the statement of changes in equity has been thoroughly discussed along with the different components of equity. So this is something that we'll get back on in subsequent slides. Using all of these definitions and from the conceptual framework, we can imagine the formula of equity using simple algebra as one that you can see from the slide. So equity is the residual interest from your assets after deducting all of your liabilities. So E is equal to A minus L. But even knowing this formula, there is a lingering question that we should address. Because it seems like in this formula, you need to first define what are your assets and what are your liabilities in order for you to determine your equity. But in reality, that is not the case. So in the most practical terms, equity is the remaining assets that you will have after you pay your liabilities, hence the term residual interest. So I know it sounds like a rehash of the previous definitions, but please hear me out through practical examples. So if we revisit the examples we had in the previous videos, we discussed that if you have $500 in the bank as a business, and then you had to pay for a $100 liability in the future, so the remaining assets that you have is your equity, since this is the residual amount that you have after paying your liabilities. So your equity calculation will be as follows. 500 of assets minus 100 liabilities, equity is equal to 400. Same as the amount that we see here. So that is an illustration of the residual interest definition of equity. But although it has no specific definition, it doesn't appear out of nowhere like that. In fact, due to the double entry nature of accounting, we are actually accounting for equity almost at the same time as assets and liabilities. So now I would like to focus on the discussion of two things. Number one, what are the sources of equity? And as much as we have sources of assets and liabilities, we should have sources of equity as well. And what are the components of equity? If we can define cash and trade receivables as assets, we should also define some certain terms or components to be within the element of equity as well. So in the previous example, if you are talking about $400 of equity, your questions would be, where did it come from? And what is it composed of? Broadly speaking, since equity pertains to the business owners, it comes from two general sources. Number one, from direct contribution of the owners of the business, meaning that when shareholders or owners of the business contributed directly to the business, like if this is the business owner, and let's say that this is the personification of the business. The business owner is giving money directly to the hands of the business. So that is a direct contribution. The second one is from operations or other sources, other than the owners of the business, meaning those activities with customers and suppliers that are directly related to business objectives. In other words, those that generate income or expenses. The results of these activities will eventually redound to the owners or shareholders, or to equity. This is different from A, and this is B. So operations, this one, the second one, is different from A because in A here, equity increased because there was money that came from the shareholders' pockets. In B, if this is a customer, equity will increase because there is money that came from the customer's pockets. So these are the two main sources of equity, either from owners or broadly speaking from the customers or the suppliers through income and expenses. So the two sources of equity will then translate to the components of equity. We talk about components of equity because I want to align it with your knowledge in assets and liabilities, in which you can think of certain examples of these two when asked. For example, if for assets, you can immediately think of cash. For liabilities, you can immediately think of trade payables, for example. For equity, what is something that you can think of as an example? So that's something that I want to address in this slide. So the components of equity will largely depend on its source. And this is true for almost all companies right now. Unlike assets and liabilities, the components of equity are pretty standard. We have direct contribution again, and from operations and others as the sources of equity. The direct contributions from owners, meaning those to or from the pockets of the owners, go directly into equity. They do not go through income and expenses, unlike the second one. And discussion will depend on this. If this is a corporation or other type of companies like sole proprietorship or partnerships. So if you own a small business and you are not registered as a corporation, you will be interested mostly on this first part. For the sole proprietorships and partnerships, components of equity from direct contribution are pretty simple. Most of the time, we only refer to them as capital contributions. Capital contributions. In the financial statements, you will see a single line that says capital contributions, showing the amount of contribution by the sole proprietor. For example, if the business is a partnership, meaning it has multiple owners, you can separate them per partner or per owner. Owner A, owner B, who contributed $120. The other one contributed $180 for total equity of $300. It's important to separate both of them because you need to track how much each owner is contributing to the business. So for a corporation, it can be a little bit different. Common items inside equity are the following. We have ordinary shares or preference shares. These are specific units that represent ownership of the business. Owners or shareholders pay for these to signify that they own a part of the company. In general, the equity of a corporation is subdivided into units. And there is a fixed price for each unit. Say the business has 100,000 units. This is just an example at $1 each. So a person can buy ownership on this corporation up to 100,000 units only. However, you have to remember that corporations can be valued more than the par value or this value of $1. So you can actually pay more. For example, for one unit, even though it is priced at $1, you can pay for $3 per share. So the $1 will go to ordinary preference share or your preference shares. And then the $2 will then go to share premium. That's the third component that I want to discuss. So it is split between 1 here and 2 here. Share premium represents the amounts paid in excess of the ordinary and preference shares because ordinary and preference shares are fixed amounts. In general, those are the direct contribution components that we have. For the second part, operations/others, they do not go directly into equity. They pass through income or expenses using this income statement. Then the amounts in the income statement go to equity. It's a two-step process. Then in equity, it goes to specific components, which is what I want to discuss right now. So they go to retained earnings, which is the most common one. And the less common one, we have the other comprehensive income. The retained earnings contain the cumulative income and expenses or profits both from the current year and the prior years, while the OCI or the other comprehensive income contains very specific items defined by the standards as other comprehensive income. We will not discuss this for now, but this is a good way to introduce the concept of the OCI for future discussions. Both of these are applicable whether it's a corporation or other types. Unlike the one in the first example, which is the direct contribution. It is a little bit complicated to discuss equity without touching the double entry bookkeeping system, but I hope I have described it sufficiently. Of course, you can revisit this video anytime, once we are done discussing the double entry bookkeeping system in the future. So to be completely honest, I could have finished our discussion with the previous slide, but I am putting in another question for you, to generate some more interest in the topic. So what's so special about equity? For me, at least for me, the equity is special because it is an element of financial statements that you need to account in detail what happened to its components from beginning to end, using the statement of changes in equity. The statement of changes in equity, as we have discussed before, is first mentioned in IAS 1 if you want to read further. The other elements of the financial statements, you just need to present side by side the year-on-year balances. So for example, if we have the current year as year 2, the previous year as year 1, this is how a normal condensed balance sheet or financial statement will look like. This is the assets, liabilities, and equity. For example, in the current year, we have 500 assets, 100 liability, and 400 equity. In the previous year, we have 400 assets, 200 liabilities, and 200 equity. You can see that the formula for equity is still applicable. 500 minus 100 is equal to 4. 4 minus 4 is equal to 200. So this is a complete financial statement condensed for purposes of illustration. So for assets and liabilities, I'm talking about in general the element assets and liabilities, 500, 100. You do not need to explain the movements unless it's in the notes to financial statements. We do not need to explain why this 400 became 500 or this 200 became 100. But for the assets, there is one exception for cash because we need to present the statement of cash flows. For liabilities, there's no need for us to explain why this full 200 decreased to 100. What liabilities did we pay? So we need to explain that in the notes, but not as a separate financial statement. But for equity, you need to explain in detail why this 200 of equity from year 1 became 400 in year 2. Why the equity increased by 200 in just 1 year. Statement of changes in equity can look like this: beginning, ending. The beginning is 200, the ending is 400. So if you squeeze in a number, you have 200 here. So their question is, what is that 200? That is the purpose of the statement of changes in equity, which is only applicable for equity as an element of the financial statement. You need to ask yourself, where did the 200 come from? Did we receive another 100 contribution? And maybe 100 is from the profits or the income and expenses. So it's something that you need to address as a separate financial statement, which makes equity very interesting for me. Let's take a look at an actual example in the next slide. The one in the slide is the September 2020 financial statements of Apple, the one that makes iPhones. It is a listed company, so it's readily available online. As I have said, for equity balances, you have to account for what happened from beginning to end for all components of equity. You will see that for Apple, they have 3 components of equity: the common stock or the ordinary shares. You will notice that they included the additional paid-in capital or the share premium in this line. The second component are the retained earnings, as we discussed. The third component are the accumulated other comprehensive income, or the OCI. This one, as we discussed, came from contributions from their shareholder. And these two came from operations and others. So how do we illustrate the statement of changes in equity, where they account for everything from beginning to end? They have presented 3 periods for the statement of changes in equity, and these are the ending balances. 40 billion 201, which is the ending balance of last year, is the beginning balance of next year in 2019. The ending balance of 2019, 45 billion, is also the beginning balance of 2020. It holds true for all the elements, or for all the components. And we call this a roll forward analysis. Actually, this is a roll forward. So you will see that for every movement, you have to explain it. So for the common stocks, they're saying that they issued new common stock or ordinary shares for 880 million during the year. And they also have other types of movements leading up to a balance of 50 billion at the end of the year. They have 14 billion of retained earnings and negative 406 billion of OCI, which leads up to 65 billion of equity at the end of September 26, 2020. It means that if Apple is liquidated now, their shareholders will receive a total of 65 billion, which will need to be split among the stockholders. Because this, as we discussed, this is already the shareholders' equity. This is already net of all the liabilities. So as an accountant, it is a normal mistake, especially early on in your career, to easily pass off some entries as equity adjustments. So you need to be careful. Do not adjust retained earnings or share capital unless they are properly evaluated or substantiated, because anything you do there in equity will be disclosed in the statement of changes in equity and should be properly accounted for or described, just like here. So it's no joke. So in summary of this video, equity is residual. Assets minus liabilities is equal to the equity. In general, equity comes from both contributions and operations/others. And lastly, we need to prepare the statement of changes in equity as a primary financial statement. So that's it. I hope that this discussion has helped you understand the concept of equity a little bit more. Now that we have discussed all the main elements of the statement of financial position, assets, liabilities, and equity, I bet you are now ready for the accounting equation and all other exciting new topics. Again, don't forget to subscribe and click the notification bell below to keep yourself updated on the next week's lessons. Bye!